Before we begin today's analysis, a brief word about this channel. If you value thoughtful, disciplined financial education that respects your intelligence and your capital, I invite you to subscribe. We don't chase headlines or sell excitement. We examine markets with precision, patience, and a commitment to helping you make informed decisions. You'll find the red subscribe button below this video. A simple click ensures you receive future insights as we navigate these complex markets together. Now, let's turn our attention to a developing situation in the silver market that demands your careful consideration. Within the next 5 days, institutional demand for physical silver may surge by approximately 125 million ounces. The available supply in registered vaults, roughly 80 million ounces. This isn't speculation, this is mathematics. When demand exceeds supply by this magnitude, markets don't simply adjust smoothly. They convulse, prices disconnect from recent patterns. Participants who understood the mechanics beforehand position themselves advantageously. Those who didn't scramble reactively, often at the worst possible prices. Today, we're going to walk through exactly what's happening, why it matters, and most importantly, how you can approach this situation with discipline and strategic clarity. Whether you currently hold silver or you're considering a position, the next 25 minutes will provide you with a framework for rational decision-making during a period when emotion will drive most market participants. Let's begin with the fundamental question. What exactly creates a situation where institutional buyers might seek 125 million ounces when only 80 million exist in immediately accessible form? The answer lies in the derivatives market, specifically in silver futures contracts. A futures contract represents an obligation to deliver physical metal at a specified future date. When traders purchase these contracts, they're often doing so for price exposure, not because they want physical delivery. Similarly, sellers typically don't intend to deliver actual metal. Most contracts settle financially before expiration, but occasionally, large players decide they want the physical asset. When this happens at scale, the market faces what professionals call a delivery squeeze. Here's why this matters to you, even if you've never touched a futures contract. The futures market doesn't exist in isolation. It directly influences the price you pay for physical coins, bars, or mining company shares. When institutional demand floods the delivery system, that pressure ripples immediately into every corner of the silver market. Premiums on physical products rise, wait times extend, dealers adjust their spreads, mining stocks respond to the perceived supply constraints. Understanding this mechanism allows you to anticipate rather than react. Let's examine the specific dynamics creating this 5-day window. Silver futures contracts on major exchanges follow monthly expiration cycles. As expiration approaches, contract holders must decide: roll forward to a later month, close the position, or stand for delivery. Recent data indicates an unusual concentration of open interest in the approaching contract month, combined with an uncommonly high percentage of traders declaring their intention to take physical delivery. Simultaneously, the registered inventory available for delivery sits at multi-year lows. This convergence is not coincidental. Large institutional players have observed the structural deficit in physical supply relative to industrial and investment demand. They've recognized that purchasing futures and demanding delivery can expose this vulnerability while potentially securing metal below replacement cost. Think of it as a controlled test of the system's ability to fulfill its fundamental promise: delivery of physical metal on demand. The market is about to grade itself on that test. What makes the situation particularly significant is the compressed time frame. Delivery obligations don't extend over quarters. They crystallize within days. Either the metal appears, or settlement arrangements must be negotiated, often at premiums to spot price. For those holding existing positions, this represents volatility risk and opportunity simultaneously. For those considering entry, it presents a decision point requiring clear thinking rather than reactive impulse. Markets have memory, even when participants don't. This isn't the first time silver has faced supply-demand dislocations. Understanding past episodes provides essential perspective. In early 1980, silver reached extraordinary price levels due to concentrated buying by the Hunt brothers, who sought to corner the market. The subsequent regulatory response and forced liquidation created a collapse that shaped silver investor psychology for decades. The lesson wasn't that silver lacks value. The lesson was that leverage, concentration, and regulatory risk can overwhelm fundamentals in the short term. In 2011, silver rallied sharply as investors sought inflation hedges and alternatives to financial assets. The rise was swift and emotional. The subsequent correction was equally severe, as leveraged positions unwound and momentum traders exited. Again, the underlying supply-demand story remained intact, but short-term price action devastated those who confused a thesis with a guaranteed outcome. More recently, in early 2021, retail coordination attempted to squeeze silver shorts. While this created temporary premium expansion in physical products, the sheer depth of the paper silver market absorbed the pressure without breaking. Each episode teaches the same core principle. Understanding the difference between underlying fundamentals and short-term price mechanics is essential for survival and success. The current situation differs from these historical parallels in one critical respect. This isn't retail coordination or individual concentration. This appears to be institutional positioning based on structural supply deficits that have developed over years, not weeks. Industrial demand has consistently exceeded mine supply. Above-ground inventories have declined steadily. Investment demand has revived as monetary policy uncertainty persists. When institutions move based on multi-year supply-demand analysis, rather than momentum or manipulation, the implications extend beyond short-term volatility. This doesn't guarantee immediate price appreciation. It suggests the possibility of a regime change in how silver trades relative to recent patterns. Silver doesn't trade in a vacuum. Its price reflects the intersection of industrial demand, investment demand, and monetary conditions. Let's examine each layer. Industrial demand for silver has grown substantially over the past decade. Solar panel manufacturing now consumes approximately 100 million ounces annually. Electric vehicles require significantly more silver than internal combustion vehicles. Electronics, medical applications, and emerging technologies continue expanding consumption. Critically, industrial users typically don't reduce consumption in response to moderate price increases. Silver represents a small input cost in high-value finished products. A manufacturing halt costs more than elevated silver prices. This creates relatively inelastic demand. Investment demand responds to different drivers entirely. When investors lose confidence in currency stability, they seek stores of value. Gold receives primary attention, but silver offers similar properties at a lower entry price point, with potentially greater volatility. Current monetary conditions favor this dynamic. Central banks globally maintain balance sheets at historically unprecedented levels. Government debt continues accumulating. While inflation has moderated from peak levels, the structural factors supporting currency debasement remain in place. You don't need to believe in imminent monetary collapse to recognize that these conditions support precious metals allocation as portfolio insurance. The third factor is monetary policy positioning. Interest rate cycles profoundly impact precious metals. When real interest rates turn negative, holding non-yielding assets becomes relatively attractive. When rates rise substantially, opportunity cost increases. We're currently in a transitional phase. Central banks have paused aggressive tightening but haven't committed to sustained easing. This uncertainty creates tension in rate-sensitive assets, including metals. Silver historically performs best when real rates are falling or negative, and when broader commodity prices are rising. We're entering a period where both conditions may align. Understanding these macro forces prevents you from attributing every price movement to the specific supply story we're discussing. Multiple factors will influence outcomes simultaneously. Distinguishing signal from noise requires this broader perspective. How will market participants respond to a confirmed supply squeeze? Psychology, not mathematics, will determine short-term price action. Initial confirmation of delivery difficulties will likely trigger immediate buying from momentum traders and those who fear missing opportunity. This can create rapid price appreciation disconnected from rational valuation frameworks. This phase feels exhilarating for existing holders. It's also the most dangerous. Euphoria clouds judgment. Confirmation bias intensifies. Risk management discipline erodes. Participants begin projecting linear moves into the indefinite future, forgetting that all markets eventually revert or consolidate. Following this initial surge, if it occurs, comes the testing phase. Profit-taking begins. Early buyers exit. Skeptics declare the move overdone. Media attention increases, bringing less informed participants into the market precisely as the easy gains have been captured. This creates volatility and psychological whipsaw. Those who entered with conviction based on fundamental analysis can withstand this turbulence. Those who entered based on fear of missing out typically sell at the worst moments, often at a loss, despite the underlying thesis proving correct. The final phase, if the structural supply deficit persists, involves institutional repositioning and broader acceptance of higher price ranges. This phase develops over months or years, not days. It's characterized by episodic volatility, but persistent higher lows. It requires patience and conviction that most market participants lack. Your psychological preparation for these phases matters as much as your analytical preparation. Are you positioned to endure a 40% correction in a holding that you believe will ultimately rise 200%? Can you avoid adding to positions emotionally during manic phases? Will you maintain your exit strategy if your thesis invalidates? These questions have no comfortable answers. They require honest self-assessment. Markets don't reward brilliance. They reward discipline applied consistently under psychological pressure. If you currently hold physical silver, mining shares, or silver-related instruments, this section addresses your specific considerations. First, reassess your position size relative to overall portfolio allocation. Concentrated positions amplify both gains and losses. If silver represents more than 10 or 15% of your investable assets, consider whether that concentration aligns with your risk tolerance and financial objectives. Excitement about potential upside shouldn't override prudent diversification. Second, review your holding structure. Physical metal offers no counterparty risk but requires storage and insurance considerations. Exchange-traded products provide liquidity but introduce structural risks. Mining shares offer operational leverage but bring company-specific risks independent of metal prices. Diversification across holding types can reduce specific vulnerabilities while maintaining overall exposure. Third, establish clear exit parameters for portions of your position. This doesn't mean selling everything at the first sign of profit. It means determining in advance what would cause you to reduce exposure. Perhaps you commit to taking 25% profits if prices rise 50% within 60 days. Perhaps you establish a trailing stop at 15% below peak prices. Perhaps you've identified fundamental conditions that would invalidate your thesis entirely. Whatever your framework, decide now before emotion intensifies. Fourth, resist the temptation to add aggressively on momentum alone. If you've done proper position sizing initially, there's no need to chase. Adding to positions should reflect either new fundamental information that strengthens your thesis or opportunistic purchases during weakness, not fear-driven buying during strength. Fifth, consider tax implications if you're holding in taxable accounts. Short-term capital gains face higher tax rates than long-term holdings. Strategic timing of any sales can materially impact after-tax returns. Consult with tax professionals before making hasty decisions. Sixth, maintain emotional equilibrium regardless of short-term price action. If prices surge dramatically, remember that volatility cuts both ways. If prices initially decline despite the supply story, remember that fundamental imbalances often take time to fully express in market prices. Your ability to remain rational while others oscillate emotionally provides genuine edge. Finally, stay informed but avoid information overload. Following every tick, every rumor, every social media claim will exhaust you and degrade decision quality. Establish a disciplined information diet. Perhaps you check prices once daily, review substantive analysis weekly, and reassess your overall thesis monthly. This prevents reactivity while maintaining awareness. If you're evaluating whether to establish or expand silver exposure, different considerations apply. First, examine your motivation honestly. Are you responding to fear of missing opportunity? Are you following crowd behavior? Or have you independently concluded that silver offers favorable risk-reward characteristics aligned with your financial goals? Only the last motivation provides sustainable foundation for investment decisions. Second, understand that timing market inflection points is exceptionally difficult. Even when fundamental analysis proves correct, interim volatility can shake out positions entered with poor timing. Rather than attempting to perfectly time a single entry, consider scaling into positions gradually. Perhaps you allocate 25% of your intended position initially, with subsequent purchases at predetermined intervals or price levels. This approach reduces timing risk and prevents emotional overcommitment. Third, prioritize education before capital commitment. Understand the difference between futures, options, ETFs, closed-end funds, mining equities, and physical metal. Each instrument carries different risk profiles, cost structures, and suitability for various investor types. Physical metal suits those prioritizing tangible assets and long-term holding. ETFs suit those seeking liquidity and minimal friction. Mining equities suit those comfortable with operational risk in exchange for leverage. Derivatives suit experienced traders with sophisticated risk management capabilities. Mismatching instrument to objective creates unnecessary complications. Fourth, assess how silver fits within your broader portfolio context. Precious metals typically serve as portfolio diversifiers and insurance rather than growth engines. A position sized at 5 to 10% of portfolio value provides meaningful exposure without creating undue concentration. If you wouldn't be comfortable holding through a 50% decline, you're positioned too aggressively. Fifth, establish entry discipline rather than market ordering into excitement. Place limit orders at prices you've determined offer value. Be willing to miss the move entirely rather than chase at any cost. Markets create repeated opportunities for patient, disciplined participants. Sixth, separate investment capital from speculative capital mentally. If you're allocating funds you cannot afford to lose, you're not investing, you're gambling. Silver, like all volatile assets, should only absorb capital whose loss wouldn't materially impact your financial security. This isn't pessimism, it's prudence. Seventh, ignore short-term price predictions and focus on asymmetric risk-reward. No one knows whether silver will rise 20% or fall 20% over the next 3 months. What matters is whether current prices offer favorable long-term risk-reward given supply-demand fundamentals, monetary conditions, and portfolio diversification benefits. If you can articulate why silver at current prices offers asymmetric upside relative to downside, without relying on specific forecasts. You've done the necessary work. Finally, prepare for psychological discomfort. The best investment opportunities rarely feel comfortable. If entering a position generates anxiety, that's often validation that you're acting with appropriate caution. If entering generates excitement and certainty, that's often a warning signal. Paradoxically, discomfort during rational analysis often indicates proper positioning. Regardless of whether you currently hold silver or are considering entry, certain behavioral patterns destroy capital predictably. Understanding these mistakes intellectually isn't sufficient. You must commit to avoiding them systematically. Using margin, options, or leveraged instruments amplifies gains and losses equally. During volatile periods, leverage that seems manageable in calm markets can force liquidation at catastrophic prices. If you cannot comfortably hold positions through 50% adverse moves without financial or psychological distress, you're over-leveraged. Reduce position size or eliminate leverage entirely. Reacting to daily or weekly price movements guarantees buying near peaks and selling near troughs. Markets specifically punish this behavior through volatility designed to shake out weak hands. Establish position sizes and holding parameters in advance. Execute them mechanically, regardless of emotional impulses. This discipline alone places you ahead of most market participants. Having conviction about fundamental supply-demand dynamics doesn't mean outcomes are guaranteed or that timing is predictable. Markets can remain disconnected from fundamentals far longer than intuition suggests. Maintain intellectual humility. Be willing to acknowledge when evidence contradicts your thesis. Adjust positions based on new information rather than defending past decisions. The strongest urge to buy typically occurs after substantial price appreciation, precisely when risk-reward has deteriorated. Similarly, the strongest urge to sell occurs after major declines, often near optimal entry points. Train yourself to feel discomfort during obvious consensus moments. When everyone agrees silver will rise, probabilities favor consolidation or correction. When universal pessimism prevails, opportunities often emerge. Brilliant analysis becomes irrelevant if poor position sizing creates portfolio risk that forces premature exits. A position that would generate 100% returns becomes worthless if you must liquidate at a 50% loss due to inadequate planning. Never allow single positions to represent make or break outcomes for financial goals. Diversification isn't about diluting returns. It's about ensuring you survive to capture long-term opportunities. Information quality on social media and message boards approaches zero. Confirmation bias concentrates dramatically in these venues. Following crowd sentiment provides comfortable validation but poor financial outcomes. Develop independent analytical frameworks. Seek disconfirming evidence actively. Engage with intelligent skeptics rather than echo chambers. Frequent trading generates tax inefficiency and transaction costs that compound into significant return drags. Every unnecessary trade reduces long-term wealth accumulation. Minimize turnover. Hold investments long enough to capture long-term capital gains treatment when applicable. Consider tax-advantaged account placement for volatile assets like precious metals. Without predetermined exit conditions, both for taking profits and cutting losses, you'll inevitably make emotional decisions under pressure. Markets punish indecision and reward systematic execution. Write down specific conditions that would trigger position reductions or exits. Review these periodically when calm. Execute them mechanically when conditions arise. Holding only mining stocks exposes you to company-specific operational risks independent of metal prices. Holding only physical metal creates liquidity constraints and storage concerns. Holding only ETFs introduces counterparty and structural risks. Diversify across instruments within your precious metals allocation to reduce specific vulnerabilities. Price volatility and fundamental risk are distinct concepts. Silver will likely experience substantial price swings regardless of long-term direction. If you define these swings as risk requiring action, you'll trade yourself into poor outcomes. True risk is permanent capital loss, not temporary price fluctuation. Train yourself to tolerate volatility without reactivity if underlying fundamentals remain intact. Avoiding these mistakes won't guarantee success, but it dramatically improves probability of capturing favorable outcomes when your analysis proves correct while protecting capital when it doesn't. Silver doesn't move in isolation from broader financial markets. Understanding the concurrent dynamics across asset classes provides essential context. Equity markets currently face elevated valuations by historical measures, particularly in technology-heavy indices. While this doesn't predict immediate correction, it suggests limited margin for disappointment and potential for rotation into alternative assets during volatility. Precious metals historically benefit from equity market uncertainty, not because they rise when stocks fall, but because they attract capital-seeking diversification and preservation. Bond markets reflect continued uncertainty about inflation trajectories and central bank policy paths. Yield curve dynamics suggest confusion rather than consensus. This ambiguity supports precious metals, allocation as portfolio insurance. Currency markets show persistent dollar strength against most alternatives, which typically creates headwinds for dollar-denominated commodities, including silver. However, this relationship isn't mechanistic. Periods exist when both dollar and precious metals strengthen simultaneously, reflecting flight to quality dynamics. Pay attention to real interest rate trends rather than nominal rates alone. Silver typically underperforms when real rates rise substantially and outperforms when real rates decline or turn negative. Commodity markets broadly show mixed signals. Energy prices remain volatile. Agricultural commodities reflect weather and geopolitical uncertainties. Industrial metals send conflicting messages about economic growth expectations. Silver occupies unique space as both industrial and monetary commodity. It responds to economic growth indicators through industrial demand and to monetary policy through investment demand. This dual nature creates complexity but also opportunity. Credit markets deserve attention. Corporate credit spreads indicate market perception of default risk and economic stability. Widening spreads typically precede economic difficulties and favor defensive assets, including precious metals. Finally, monitor geopolitical developments not for short-term trading signals, but for structural implications. Trade tensions, monetary coordination between central banks, and fiscal policy trajectories all influence the environment in which silver trades. You don't need to become a macro expert across all markets. You do need sufficient awareness to recognize when multiple indicators align in ways that support or contradict your precious metals thesis. What specifically should you monitor over the immediate delivery period? First, watch for official exchange announcements regarding delivery volumes and registered inventory changes. These provide factual data about whether the squeeze materializes as anticipated. Second, observe premium behavior on physical products. Widening premiums indicate retail supply constraints, confirming institutional delivery pressures. Stable premiums suggest ample physical availability despite futures market dynamics. Third, note price action during specific trading hours. Unusual volatility during typical delivery notice periods signals acute pressure. Calm trading suggests resolution through alternative arrangements. Fourth, pay attention to basis relationships between futures and physical prices. Convergence is normal as expiration approaches. Divergence indicates settlement difficulties. However, avoid obsessive monitoring. The 5-day delivery window represents one data point in a longer-term structural story. Whether this specific contract period creates dramatic outcomes or resolves quietly, the underlying supply-demand imbalance persists. Think in terms of years, not days. The current situation may prove to be an inflection point that accelerates price discovery, or it may resolve with minimal immediate impact, simply adding one more stress point to a system that eventually breaks under cumulative pressure. Your investment framework should remain robust under either scenario. If you've positioned appropriately relative to risk tolerance and portfolio objectives, short-term outcomes become interesting data rather than emotional crises. If you've overcommitted emotionally or financially, the next week will generate psychological stress regardless of price direction. This is why process matters more than prediction. A disciplined investor with moderate exposure who proves incorrect suffers minor portfolio impact and learns valuable lessons. An undisciplined investor with excessive concentration who proves correct often still generates poor outcomes through emotional mismanagement of winning positions. Focus on controllable variables, position size, risk management, emotional discipline, and continuous learning. Let market outcomes emerge from sound process rather than attempting to force specific results. We've covered substantial ground. Let's consolidate the essential takeaways. A potential supply-demand mismatch in silver delivery markets has created a decision point for market participants. 125 million ounces of demand meets 80 million ounces of immediately available supply. Mathematics suggests pressure. Markets will determine how that pressure expresses. You now understand the mechanical drivers behind this situation, the historical context providing perspective, the macroeconomic forces influencing outcomes, and the psychological patterns that will determine short-term price behavior. More importantly, you have frameworks for rational decision-making regardless of your current positioning. If you hold silver, you've received guidance on position management, risk assessment, and emotional discipline to navigate volatility productively rather than reactively. If you're considering entry, you understand the importance of proper motivation, graduated positioning, instrument selection, and integration within broader portfolio context. For everyone, you've learned critical behavioral mistakes that destroy capital predictably and strategies for avoiding them systematically. Here's what I want you to internalize as we close. Financial markets exist to transfer wealth from the reactive to the disciplined, from the emotional to the analytical, from the short-term focused to the patient. The current silver situation creates opportunity precisely because it will generate emotional extremes. Fear and greed will drive most participants. Euphoria and despair will cloud judgment. Narratives will overwhelm analysis. This is where you gain advantage, not through superior prediction, No one possesses consistent forecasting ability across volatile markets, not through perfect timing. Entry and exit precision remains elusive for professionals and amateurs alike. Your advantage emerges from process discipline, from sizing positions appropriately so volatility doesn't force premature decisions, from establishing clear frameworks in advance so emotion doesn't dictate behavior during stress, from maintaining perspective that short-term price action reveals little about long-term value. Wealth accumulation isn't about identifying the single perfect investment. It's about consistently making slightly better decisions than the average market participant, compounded over years and decades. Silver may rise dramatically over the coming months. It may consolidate or correct before resuming longer-term trends. Specific short-term outcomes remain uncertain. What isn't uncertain is this: disciplined participants who manage risk appropriately, maintain emotional equilibrium, and execute systematic strategies will capture favorable outcomes when opportunities arise while preserving capital when thesis proves incorrect. Undisciplined participants will generate poor outcomes regardless of market direction. You've invested 25 minutes in developing understanding and framework. That investment only generates returns if you implement what you've learned. Review your current positioning, assess whether it aligns with principles we've discussed, make necessary adjustments while calm before market pressure intensifies. Write down your position management criteria. What would cause you to add, reduce, or exit? At what position size would you become uncomfortable? How will you maintain discipline when emotion intensifies? This preparation won't guarantee wealth. It will ensure you approach markets with professionalism and discipline that serve you across decades of investing, far beyond any single opportunity. The silver supply-demand story represents one chapter in your longer financial journey. Handle this chapter with intelligence and discipline, and you'll build capabilities that serve you across countless future chapters. Markets reward those who respect their power while refusing to be controlled by their psychology. Be informed, be disciplined, be patient. The next 5 days will provide data. The next 5 years will provide outcomes. Approach both with the professionalism they deserve. Display the red subscribe button prominently at the beginning of the video during the subscription call to action, and maintain subtle subscribe button visibility throughout the video's lower third or corner where appropriate.